Hi traders, you are welcome back to the Forex Geek channel. If you are looking to take your trading to the next level, then you are in the right place. Okay, in this video, we're going to be diving deep into the supply and demand flip zones. All right, and this is a game-changing strategy that can help you spot market reversals and execute high probability trades. Whether you are just starting out or you are already an experienced trader, understanding supply and demand flip zones is crucial for your success in the forex markets. Okay, but before we jump into it, make sure to hit that like button if you found this video helpful, and subscribe to the channel for more expert trading strategies. Okay, you don't want to miss what is coming next, right? So what are supply and demand flip zones, right? First things first, let us talk about supply and demand flip zones. In basic terms, supply and demand are the forces, right? Supply and demand are the forces that drive price in the market. Okay, supply is where sellers are ready to sell. Okay, that's where we have a supply zone where sellers are ready to sell, and demand is where buyers are looking to buy. All right, where buyers are looking to buy. So when price reaches a level where there is significant supply or demand, it tends to reverse. Now, flip zones occur when price reacts to these key levels but then reverses or flips in the opposite direction. So these areas often signal a strong market reversal. For example, when price hits a demand zone but fails to go higher, it can flip and head back down. Similarly, when price reaches a supply zone and fails to break through, we could see it reverse back downwards. All right. So by identifying these flip zones, we can anticipate where the market is likely to change direction and position ourselves for higher probability trades. So how do we identify these flip zones? Let us break it down step by step. The first step is to look for strong supply and demand zones, right? The first thing you need to do is identify areas of strong supply and demand. Now, these are typically levels where price has reversed in the past, okay, with significant momentum. For instance, if price has recently reversed at a certain level and moved away with strong movement, that's a potential supply or demand zone to keep an eye on. To find these levels, you need to look at past price action. All right, you need to look at past price action and check where price made sharp moves. If the price is consistently reacting to a particular level, then that area holds significant importance. Now, these levels are the foundation of your flip zones, all right? The second step is to look for price reaction. So once you've identified potential supply and demand zones, you want to see how price is reacting when it revisits those areas. All right, let's just see if we can find another example, right? Okay, I'm going to zoom out a bit. Okay, so we can see that here, this particular zone that I highlighted, you can see that that zone actually, it is not a new zone, right? You can see that that zone has been existing for quite a while. So now we're talking about how price reacts when it gets to that zone, right? When it revisits that zone. So we can see that this was a significant supply zone, okay? So you'll notice that on several occasions when price approached this supply zone, you will see how the price always got rejected. Now, mind you, you can see that this was since 2023. You can see the date here, 2023. You can see here was 2024. It got rejected again here and here. You can see, and this is 2025. So it kept on getting rejected over and over again, right? We can see that this is a significant supply zone that got rejected, and if we keep dating back, if we keep going backwards, we'll likely see that this particular zone, can we see this particular zone has held for years, right? We can see that this might actually, let me just place a horizontal level here, right? Let me place a horizontal level here, and let's move forward. Okay, so that was just a little above It was just a little above this zone. Okay, so but we can see that over the past few years, this level has held, right, as price always got rejected, kept on being rejected over and over again, right? So it is possible, if this pattern continues to hold, it is possible that just like how it has been since 2023, right, it did this in 2023, it did it again in 2024. Now there is actually a possibility that we might have this happen again in 2025. Now remember that this is just technical analysis, and it is possible for a pattern to get broken, right? It doesn't mean that it might always play out the same way, but if the pattern should hold what it did in 2023 and repeated it in 2024, there's a possibility that it might do that again in 2025. Okay, now when you have observed price reactions, remember that these are important because they tell you that the market is flipping, meaning that the momentum is changing and the price is likely to reverse. Okay, then the next step for you to do is to watch for confirmation candles. All right, after spotting a potential flip zone, it is critical to wait for confirmation before entering a trade. Now, this could come in the form of a reversal candlestick pattern, such as a pin bar, an engulfing candle, or a doji, right? Now, these candlestick patterns act as a confirmation, that the price is indeed reacting to the supply or the demand zone, right? That a flip is likely. Okay, and that a flip is likely. So you don't want to rush into trades just based on price approaching a zone. Wait for price action confirmation to make sure that the reversal is real. Okay, so matching supply and demand flip zones can be a game changer for your trading, because they give you a precise way to time your entries and exits. Now, these zones are incredibly powerful because they reflect where the big money is moving in the market, like institutional traders and large market participants. Okay, because they often base their trades around these key levels. So if you are able to spot these flip zones early, you can get in before the market, the big moves, actually before the big moves happen, giving you a strong edge in the market. So trading with the trend is always important, but trading at these key levels, where the price is most likely to reverse, can significantly increase your win rate and improve your overall consistency. Now, how do you use flip zones in your trading strategy? Let us talk about how to incorporate flip zones into your overall trading strategy. Here's how you can start using these zones effectively. The first thing to do is to wait for the zone to be tested, right? You wait for that zone to be tested. So once price has revisited a supply zone or a demand zone, this is when you will get your best opportunity to trade the flip. Remember, don't just enter a trade because the price is close to a zone. You want to see a reaction, right? You want to see a reaction. So ensure you get that reaction, ensure you get that confirmation before you enter the trade. Look for a strong reversal signal, right? Once price is around that zone, look for reversal candlestick patterns to confirm that market is changing direction. So in this scenario, we can see that we had an evening star here. Can you see that? You can see this. We had an evening star here. We had another rejection candle here again, and we had yet another evening star here, right? And then it looks as if price is still sorry about that. It looks as if price is still trying to, that trailer effect, right? Price is still trying to sellers are still, trying to take control. Buyers are not giving up yet, so we're having sort of a series of retests of this supply zone before, if the sellers prevail, then we might now have a significant decline to the downside, right? So basically what I'm saying is that you should always get your confirmations. Okay, make sure you look out for confirmation patterns, reversal candlestick patterns and all of that before you go ahead to enter your trade. Okay, and then ensure to always use your stop loss and target key levels when trading flip zones. make sure to place your stop loss just beyond the supply zone or the demand zone. Okay, if the market breaks through the zone, you'll want to be out of the trade quickly. Okay, your target should be based on previous support or resistance levels, okay, or the next flip zone that might act as a new area of support of supply or demand. Okay, and now, as always, risk management is crucial. Do not over leverage your trades and ensure that each position has a good risk to reward ratio. It's important to use proper position sizing to protect your account. So why does this strategy work so well? Why? It is because flip zones are grounded in the core principles of market psychology. Now, supply and demand are the foundational forces behind every market move. So by understanding where price is likely to reverse, we are able to align our trades with the institutional traders and big players who move the market. Additionally, flip zones give us a clear, actionable edge, rather than guessing where the market will go. So we are letting price guide us to high probability setups. This is the key to trading with confidence and precision. And that wraps up this lesson on mastering supply and demand flip zones. Okay, I hope you now have a solid understanding of how to spot these critical areas in the market and use them to your advantage. Remember, mastering this strategy can take time, all right? But once you have got it down, you'll see a huge improvement in your trading. If you enjoyed this video and found it helpful, make sure to hit that like button and subscribe to the channel so you never miss an update. Okay, we've got a ton of amazing content coming your way to help you level up your trading. Thank you for watching, and I'll see you in the next video.